General Mills reported a 50% drop in quarterly earnings for Q3 2026, a figure that immediately drew the attention of the broader market. The consolidated statement of earnings shows the bottom line results. Net earnings fell to $303 million. Looking specifically at diluted earnings per share, the figure dropped from $1.12 in the previous year to just 56 cents. Relying on these statutory headlines alone creates a misleading picture. In the midst of a major portfolio transition, GAAP metrics frequently obscure the operational health of the company. To understand the company's actual performance, we must assess earnings quality. This requires a manual reconstruction of the 10-Q to remove non-recurring strategic noise. Three factors are distorting this quarter's figures: the North American yogurt divestiture, the Whitebridge Pet Brands acquisition, and supply chain restructuring costs. By stripping away these capital allocation shifts, we can isolate the underlying operational run rate of the business. Our analysis will move chronologically down the P&L, from reported net sales to adjusted operating margins. This analysis treats the 10-Q as a collection of component parts that must be reassembled to reveal the true trajectory of the company. We begin at the top of the P&L, where General Mills reported an 8% decline in net sales. Breaking down that 8% decline reveals 6% is due to the yogurt divestiture and Whitebridge acquisition timing. Removing that noise, organic sales declined 3%, driven by a 2% drop in volume and a 1% decline in price and mix. These organic figures indicate that the company is experiencing a simultaneous loss in both shipment volume and pricing power. While the reported 8% drop reflects strategic decisions, the 3% organic decline shows that the core business is losing ground. Moving from the top line to profitability, the company reported a 41% decrease in operating profit. The operating profit margin compressed by 660 basis points, falling to 11.8%. Within the cost of goods sold, we find the conflicting drivers responsible for this margin compression. Lower production volumes resulted in $349 million in mathematical savings. However, this was largely offset by a $202 million penalty from input cost inflation and changes in product mix. This creates a loss of operating leverage. When fixed costs remain steady but are distributed over fewer units, the resulting cost per unit increases and profit margins contract. When volume declines, fixed overhead costs exert significant pressure on profit margins, impacting overall profitability. Another factor distorting the year-over-year comparison is an unrepeatable windfall hidden in the previous year's data. The income statement shows a $95.9 million gain under divestitures in the third quarter of 2025. This was a one-time gain from the sale of the Canada yogurt business. To find a normalized baseline for current operations, this windfall must be excluded. Including that one-time gain in the baseline artificially increases the perceived severity of the earnings drop in the current year. Year-over-year comparisons lose their accuracy when analysts fail to adjust for these types of unrepeatable historical events. Beyond historical distortions, we must examine the strategic costs currently impacting operating profit. The quarterly restructuring and transformation charges totaled $32.8 million. The footnotes clarify that $25.1 million of this expense is part of a multi-year $96 million initiative to modernize the supply chain. Additionally, a $52.9 million non-cash impairment of the Uncle Toby's brand suggests a systematic review of the company's portfolio. These restructuring charges are not evidence of decay, but represent funded mandates to align infrastructure with a new strategic direction. These restructuring costs are an intentional investment in organizational infrastructure, rather than a byproduct of declining operations. By accounting for M&A lags, the yogurt divestiture, prior year gains, and current restructuring, we can see the adjusted run rate of the business. This comparison shows the difference between the GAAP reporting and the adjusted reality. While the GAAP EPS fell 50%, the adjusted EPS declined by 37%. These adjusted figures still show a 37% drop in earnings per share, confirming that the business is facing structural contraction. While accounting adjustments clarify the scale of the decline, they also confirm that the core business is underperforming. We must look at why management is accepting this level of margin compression. Segment data reveals the divergence between legacy operations and new growth areas. North America Retail continues to generate $436 million in profit, while the North America Pet segment has grown to over $102 million. Management is using cash from legacy operations to fund a strategic shift. As confirmed in Note 12 and the Statement of Total Equity, the company executed $500 million in accelerated share repurchases while expanding its pet food portfolio. This represents a high-stakes transition from mature grocery categories toward higher-growth premium segments. The Q3 2026 results reflect the costs of this long-term reinvention. The data shows significant short-term margin compression, and the coming year will determine if this pivot succeeds.